Welcome to the deep dive. Today we're digging into a pretty hefty pile of financial and operational reports. We're looking at the Q2 FY26 results for, well, the telecom giant, Bharti Airtel.
Yeah, and this is, much more than just ticking boxes on a quarterly report.
Mm.
Given the sheer scale, India, Africa, you're looking at a massive capital allocator.
Definitely.
And these numbers, they really show a company trying hard, quite aggressively actually, to redefine itself.
Absolutely. So our mission here is to look beyond the, let's say, the impressive consolidated headlines, which, don't get me wrong, we will start with...
I have to.
We have to. But we want to uncover the actual strategic gears driving that growth, specifically the new moves in AI and cloud, and figure out what financial juggling is making that huge leap possible.
And those headline numbers, they demand attention right off the bat. This isn't just small steps.
Yeah.
It feels like a real surge.
It does. Total consolidated revenues, get this, hit ours 52,145 crore this quarter. That's up a massive 25.7% compared to the same time last year.
Wow.
And crucially, the consolidated EBITDA margin reached 57.4%.
Okay, hold on. A margin of 57.4% in this industry.
Yeah.
That tells you, well, two big things. Scale, obviously, but also serious pricing power.
Right.
That's a measure of operational dominance. Most companies, frankly, would kill for that kind of profitability relative to their core costs.
Sure.
It just tells us that even with all the complexity, operating across two continents, they're running a really, really tight ship.
Right. And this efficiency, it seems less like a lucky byproduct and more like the deliberate foundation for whatever comes next.
Exactly.
So let's unpack the financial discipline behind this, because that jump in profitability is, well, it's analytically fascinating.
Yeah, what really jumps out is how well they converted that top-line growth straight into bottom-line profit. Consolidated EBITDA hit ours 29,919 crore. That's up 35.9% year over year.
A 35.9% jump is huge, but then looking at net income before exceptional items, Air's 6,792 crore, that's a 73.6% jump from the previous year's quarter. Is that sustainable?
Yeah.
Or is this some kind of one-off, like cleaning up old regulatory stuff or selling assets?
Well, looking at the details, this seems mostly operational. That kind of delta, translating revenue almost directly to the bottom line like that, it's a powerful sign of their rising average revenue per user, which I know we'll get into, and just aggressive cost control. Their consolidated EBIT margin also climbed to 32.0%. That's up 5.5 percentage points from the same quarter last year. So yeah, it confirms operational leverage is like firing on all cylinders.
Okay. Now, this great performance on the income statement, it feeds directly into their balance sheet strategy, right? Deleveraging.
Exactly.
That consolidated net debt compared to their earnings, that ratio seems key.
It absolutely is. The net debt to EBITDA ratio, it's dropped quite a bit. Now stands at just 1.19 times.
1.1 times.
Yeah, which is a really noticeable improvement from 1.60 times in the same quarter last year.
Okay, before we move on, maybe we should quickly clarify some jargon for you listening. We mentioned EBITDA. What's the AL about, and why is that the measure for telecom debt?
Good point. That AL is super important. It stands for after leases. So in a capital-heavy industry like telecom, think 5G rollouts, massive infrastructure needs.
Towers, equipment.
Exactly. Those leases are significant liabilities. So using EBITDA, it gives you the purest, maybe the most conservative view of a company's actual operational debt capacity. It factors in those big long-term infrastructure payments.
Got it. So the drop from 1.6 down to 1.99 times means they're basically saving aggressively, paying down debt.
Precisely. Think of it like this. For every dollar they earn now, they've cut their debt load by roughly 25% compared to last year.
Wow.
They're generating enormous cash flows and very deliberately using that money to strengthen the balance sheet.
Yeah.
This is the financial firepower you need to attempt the next big strategic move. They're essentially clearing the runway for these potentially high-risk but also high-reward investments we're seeing.
That makes total sense. Okay, let's pivot then. Let's look at the core engine spitting out all this cash, the India business.
The powerhouse.
Yeah. It brought in Rs 38,690 crore this quarter, revenue-wise, and delivered a, frankly, stellar 60.0% EBITDA margin. What is it about the India momentum that's so consistently strong? It can't just be the number of subscribers, right?
No, it's really the successful execution of their premiumization strategy.
Yeah.
They've decisively moved up the value chain. The main driver is definitely the India mobile business.
Okay.
And you see that clearly in the industry-leading average revenue per user, ARPU. It hit RS 256 this quarter.
256, that's way up from RS 233 this time last year. So how are they doing that? Just hiking prices for everyone?
It seems more strategic than that. Strategic pricing, yes, but also bundling. They're not just raising the floor price, they're really increasing the ceiling, the potential spend. So the ARPU growth seems to be a function of two things. One, more people adopting the higher cost 5G plans.
Oh, right.
And two, successfully pushing these premium value-added services that kind of lock customers into their ecosystem. They're clearly prioritizing customers who will pay more for better service, more features.
And you can see that focus on quality, as they call it, in the numbers. Their smartphone data customer base up by 22.2 million over the past year.
Huge number.
And those customers are now 78% of their total mobile base. That's a massive concentration of, well, digital natives.
And critically, those customers seem stickier. Look at the strong postpaid performance. Postpaid usually means lower churn, higher ARPU. They added almost 1 million postpaid net adds just in Q2. Plus, these customers are data hungry. Mobile data usage, on average, hit 28.3 gigabytes per month per customer.
Wait, 28.3 gigabytes per month? That's staggering. That sounds like more data than the average American uses.
It might well be.
Suggests these customers are really, really leaning into digital. Streaming, high bandwidth apps, maybe gaming.
It definitely confirms the quality, or at least the intensity, of that customer base. These aren't just people making calls. They are deeply embedded digital consumers.
Yeah.
And importantly, the growth story isn't just mobile. Their fixed-line broadband, the home services, that's also booming.
Right, I saw that. Home services revenue up 30.2% year over year. And they had record net customer additions, 951,000 in the quarter?
Yep, bringing their total home broadband base close to 12 million now.
Wow.
And finally, the B2B side, Airtel business, showed 4.3% sequential revenue growth. What's interesting there is that this growth came even though the company explicitly said they were cutting low-margin business.
So they were focusing on, quote, quality revenues.
Exactly. So they grew the top line while actively trimming the least profitable deals. That signals, real operational maturity.
Okay, so this is where it gets really interesting, right? Connecting that operational maturity, that financial firepower we talked about. This is the part of the report that suggests the company is deliberately trying to move beyond being just a traditional pipe company.
Yes, this is the big strategic pivot.
A simple connectivity provider to becoming more of a platform ecosystem.
Definitely. They're making some aggressive, very high-profile moves. And that partnership with Perplexity AI is probably the biggest headline grabber.
Right.
They're offering a free 12-month subscription to Perplexity Pro, which normally costs a fair bit, INR 17,000 a year.
Wow.
To all 360 million of their customers. Mobile, homes, digital TV, everyone.
Hold on. They're giving away a high-value, cutting-edge AI service that usually costs quite a bit for free to hundreds of millions of people. What's the strategic play there? It can't just be generosity.
Oh, definitely not just generosity. Think of it as a brilliant anti-churn tool. And a data play.
Okay, explain. Anti-churn how?
Well, if your super useful AI assistant, the thing that helps you search better, learn faster, be more productive, is tied directly to your mobile or home broadband plan, switching providers suddenly means leasing that tool. That introduces a real practical cost and maybe even a cognitive friction to leaving.
Okay. It makes leaving harder, increases stickiness.
Exactly. They're building an instant high-friction wall against churn. Plus, think about the data. Every time someone uses Perplexity through this offer, Airtel potentially gains insights into user behavior, digital needs.
Building a massive data moat.
Precisely.
That really does change the user experience and the whole ecosystem almost overnight.
And they're building the infrastructure for that shift too, right? Through their digital arm, Xtelify.
Absolutely. Xtelify launched Airtel Cloud. It's described as a built-in India, telco-grade sovereign cloud platform.
Sovereign cloud, meaning data stays within India.
Exactly. That directly targets large Indian businesses, government bodies, organizations that need top-tier security, and crucially full data control within Indian borders.
And the sales pitch is pretty strong too. They're projecting this could save Indian businesses up to 40% on their cloud costs.
That's a huge carrot, yeah.
Big incentive. And look, Xtelify is clearly thinking globally now, too. They didn't just build this cloud for Airtel India.
Right.
They also launched an AI-powered software platform specifically for other telcos around the world. And they've already signed up big international players like Singtel and Globe Telecom.
So they're basically productizing their own internal digital expertise.
Selling software and infrastructure solutions to their peers globally. monetizing their know-how.
Okay, shifting gears slightly to digital defense. Their cybersecurity focus seems equally intense and probably vital for keeping those premium customers happy.
Oh, absolutely crucial.
We saw some pretty amazing figures, apparently validated by the MHA I4C, the Indian Cybercrime Coordination Center, about their anti-fraud work.
Yeah, those figures really highlight the payoff from their AI investments in security.
Yeah.
Their systems led to a staggering 68.7% drop in the value of financial losses their customers suffered due to cyber fraud,
68.7% decrease in losses. Wow.
and a 14.3% drop in overall cybercrime incidents happening on the Airtel network itself.
That's tangible protection. Why is shouting about this kind of security success so important for their core business?
It boils down to trust, especially when you're asking customers to pay a higher ARPU for premium services.
Right.
When a telco can actually quantify, look, we blocked over 48.3 billion spam calls and 3.2 lakh dodgy links in the past year. They're positioning themselves as more than just a pipe. They're a trusted gatekeepers in this messy digital world. That builds loyalty, reduces churn that comes from just frustrating cyber hassles.
Good point. And we should probably give a quick nod to sustainability, too. Their data center arm, Nextra, by Airtel.
Right, Nextra.
They're now powering almost 49% of their core data center energy use with renewables.
It's significant progress.
And achieved a 15% year-over-year cut in emissions. I mean, that environmental commitment, it's practically table stakes now for landing big enterprise deals, isn't it?
Agreed. It's all part of that comprehensive digital infrastructure package they're offering. You can't ignore the green angle anymore.
Okay. Let's quickly check in on the global footprint then, outside India, starting with Africa.
Yeah, Africa, still a steady, valuable part of the picture. Customer base is huge, 173.8 million.
Wow.
And revenue in constant currency grew 24.2% compared to last year. They seem focused on efficient expansion there, signing these strategic infrastructure sharing deals, like with Vodacom in places like Tanzania, DRC, Mozambique.
Smart way to grow without massive upfront capital costs.
And they're also looking ahead, prepping for the next connectivity wave with that Starlink partnership.
Right, SpaceX's Starlink. They've got licenses in 9 of the 14 African countries they operate in.
Yep, gives them an immediate satellite option for reaching remote areas, kind of a hedge.
Okay. Now, passive infrastructure services, that mainly means their stake in Indus Towers, right?
Primarily, yes.
That segment showed, well, slow but stable growth, 1.6% sequential revenue bump. Tower sharing factor looks healthy at 1.63 times.
Correct. But this is where we hit the main cautionary note. The thing flagged in the audit report.
Right, the auditor's emphasis of matter paragraph about Indus Towers. Okay, for anyone listening, what exactly is the financial risk they're pointing out here? Can you break that down in plain English?
Sure. It's basically a standard but important financial disclosure. The auditors are highlighting that one specific large customer, and everyone in the market knows who they mean, it's Vodafone Idea.
Okay.
That customer accounts for a really significant chunk of Indus Towers' revenue, and more importantly, its outstanding receivables, money owed.
Got it. So Indus is waiting on a lot of cash from this one customer. What's the risk?
The core risk is that getting that massive amount of money back is, well, uncertain.
Uncertain. Why? Because the customer might not pay.
It's more fundamental than that. It's uncertain because the statutory auditors of that large customer have themselves flagged a material uncertainty related to their ability to continue as a going concern.
A going concern issue. That sounds bad.
It's about the most serious phrase you can find in accounting language. It means the company's own auditors are questioning if the business can realistically keep operating long-term.
Wow.
This competitor's survival apparently hangs heavily on 3 things. Getting help from the Department of Telecommunications on those old AGR dues, raising more money externally, and just generating enough cash from operations.
Okay.
So the audit note explicitly tells us, look, Airtel's group management is watching this customer's financial health very closely because their financial exposure through Indus Towers is substantial.
Okay, so summing that up, while the core India mobile engine is absolutely booming, and this whole AI platform pivot is accelerating fast, there's this significant kind of isolated external risk lurking. It comes from their tower subsidiaries' exposure to a financially shaky third party. It's a really crucial counterpoint to what's otherwise a very positive story.
Precisely. It's a risk factor that needs watching.
So what does all this mean for you listening in? We've really seen 2 big narratives emerge from these Q2 results. First, there's this picture of aggressive, high-margin financial growth.
Yeah, powered by that relentless premiumization push in India and some very disciplined debt reduction.
And second, that financial strength isn't just sitting there. It's the engine funding a major strategic transformation.
Exactly. The business is changing fast. It's moving from being just, the infrastructure, the connectivity provider, the pipe,
Right.
towards becoming this vast digital ecosystem. They're using advanced cloud tech, high-value partnerships like the Perplexity one, to build this powerful moat of digital services around their core offering.
Securing future growth way beyond just selling basic data plans.
That seems to be the goal. It's a fundamental shift in the business model.
Which brings us to our final thought for you to chew on. Given this huge multi-pronged investment in AI partnerships, in proprietary software like Xtelify, and the fact they're literally giving away advanced AI tools to millions, when does a company we call a telecom provider stop being mainly defined by its network infrastructure, its pipes and towers, and start becoming primarily an AI and platform delivery company?
That's the question, isn't it?
What are the implications of that potential shift? For how we value it, for who its real competitors are, something to think about until the next time we dive deep.